Well, hey there, everyone. Welcome to Chart This with Dave Keller. Happy Tuesday, December 2nd. I am your host, Dave Keller, coming to you from a kind of classic fall, early winter day here in Redmond, Washington. It's overcast, high around 45, 50 degrees, a little damp out. Life's pretty good. I hope you have a lot to smile about wherever you're tuning in from. Thanks so much for watching our daily market recap show here. Please keep your eye peeled as well for our Market Misbehavior podcast. We're just kicking things back up. Took a week off for the Thanksgiving holiday here in the U.S. Back today, interviewed Joanne Bianco. Joanne's a senior investment strategist at BondBloxx. Talked about the fixed income markets, talked about bond ETFs. We got into all sorts of areas that I have found individual investors are under exposed to, which is the fixed income markets, not just treasury bonds, but all the nuances of different areas. We talked about a number of things. I tried to ask some pretty straightforward but interesting questions about different bets you can make, how to use ETFs, how to think about income versus risk in the fixed income space versus other asset classes. Keep your eye peeled for that episode. That should be out hopefully in the next day or two. We're sending it over to our editors now. Choppy session for stocks here. And as we dig into the charts here in a bit, you'll find the S&P was slightly higher, but ended up being kind of a doji day. Kind of a, not much happening kind of day where the open and close are pretty even. You're going to find the volatility came in a little bit. So we're still in a low volatility environment, which is pretty much what a low VIX implies, that the expectations of day-to-day volatility are pretty low. We're going to talk about sector movements. The breadth was not bad, but on the sector level, only 3 of the 11 S&P sectors managed to have a positive day. So it was not a broad advance. And besides technology, not a lot to be too excited about. With that in mind, let's get to the market recap. As always, we'll have 3 kind of general parts to the structure of the show. We'll start with a brief market recap, highlighting some of the movements I think you need to be aware of. Number 2, we'll go to the heat map, which is called the market carpet on stock charts. We'll look at some of the key sector and group themes, some of the individual names on the move that I think you should be aware of. And I've hand-selected some charts from my work through the course of the day to share with all of you. I hope that they give you some ideas, give you some context, and give you some great questions. And as questions come up, please make use of our comments section on our YouTube channel. I read every comment that comes in. Would love your feedback on the show, but especially questions, which could be part of our next mailbag episode. All right, so looking at the major averages, this is what I'm talking about, a choppy day. So think about it, right? Yesterday, we kind of opened down here around 68.05. We got just above 68.40, kind of closed more toward the lower end of the range. Today, we opened and basically spiked just above Monday's high a couple times, but every one of those times the market sold off. So we didn't get any further than yesterday's high. When we sold off, we didn't get much below today's open, also did not get much below yesterday's low, yesterday's close. So today was kind of like a digestion day of day one. This is why I love sort of looking at a 2-day period for something like the S&P 500. If you're just looking at today's trading, it's easy to draw a lot of conclusions about what it is. But when you think about what happened today versus yesterday, right, and think about the framework on yesterday and what was new today, the answer is not much, right? We basically just kind of backed and filled within the range that we established on Monday. So what we talked about on yesterday's show was last week, nice upswing for the S&P and the NASDAQ on pretty light volume, which is pretty normal for a holiday week. So I would argue you don't want to read too much into that because market's usually up on light volume on any holiday week. The question is what happens this week? And the answer so far has been an initial move higher yesterday, but not by much. And it was weak in the afternoon. And then today was just kind of more of the same. No new evidence, I would say, from a technical perspective today in terms of the structure of the S&P. I think all the questions we had yesterday not answered just yet. Having said that, I'm sure bulls will be all bulled up by the fact that technology is back in the on the top of the leaderboard. You know, the incredible rally phase in 2025 has been driven primarily by the AI euphoria, by the technology sector and related stocks that are all part of that. Semiconductors had a pretty decent day, as you'll see here in a bit. Intel having a nice breakout. At the end of the day, the S&P, after chopping around, up about 0.25%. It's kind of mid-range from where we were yesterday. The Dow a little bit better. The NASDAQ a little bit better than that. The NASDAQ composite was up 0.6%. The NASDAQ 100 up just over 0.8%. That's your top performer on the front page here. Mid caps and small caps. Mid caps were down about 1/3%. Small caps basically flat. Volatility came in. The VIX basically continued a bit lower, finished down about 2/3 of a VIX point. We're now in a 16 handle, 16.6 or so. So with the VIX remaining below 20, basically what that means is the options market is pricing in the fact that day-to-day movements should be pretty mild, right? The market's not expecting any significant price swings, or at least that's what's being priced in. So a day when the S&P is up 1/4%, that's what a VIX below 20. That's kind of the average day. Should be down maybe a little more than that, but sort of down in that sort of small movements kind of phase. Looking at other asset classes, and again, I was talking with Joanne Bianco earlier today about all things fixed income. So I don't have much of a fixed income hat, but I definitely popped it on there. I've had a lot of interaction with bond investors and traders over the course of my career. Bond futures traders. So it was interesting to sort of dig into some of those themes. We did talk about 10-year yields in the treasury market. She was sort of saying they were expecting a further downtrend in the 10-year yield. Not much after this next Fed meeting where 25 basis point cut is being priced in. She wasn't anticipating much more of a reduction in Fed funds target rate, kind of saying, well, what's the reason why the Fed should be cutting more? Like economic conditions are good enough, inflation's relatively in check. So her take was, probably 10-year yield kind of gently continues this downtrend phase for today, kind of following through on that expectation. 10-year yield's down slightly, just below 4.1%. Long bond yield about the same, around 4.75%. 5-year points just over 1% below that, around 3.7%. The TLT was essentially flat for the day. It opened a lot weaker and rallied through the course of the afternoon, but last hour pulled back to end up essentially unchanged for the day. The dollar also kind of unchanged as well. But that uptrend in the dollar, I would argue, one of the maybe more kind of important sleeper charts to pay attention to. If you're ignoring the dollar and you're all bulled up on gold and silver, remember, a stronger dollar could make that a little more of a challenge than it's been so far. Speaking of commodities, kind of mixed for the precious metals. Gold ended up down about 2/3%. The GLD sold off in the first hour and a half of equity trading, rallied through the rest of the day, but it wasn't enough to dig out of that initial hole. So down 2.5 points for the GLD. The SLV, same move out of the open, but ended up recovering a lot better. Silver's been outpacing gold here in a little while. And something to keep an eye on as well. Energy had a pretty good day, and it's had a pretty good stretch. We've been finding a lot of energy stocks popping up on our new 3-month high screens, but crude oil prices down today and the energy sector down as well. The USO was down 1.2%. Natural gas and gasoline futures were down as well. The ETFs related to those down big time as well. Cryptocurrencies, talk about a huge reversal yesterday. We're talking about Bitcoin getting down to 84,000, which is a level it's not seen in quite some time. Here, as we're going live after the U.S. equity close, Bitcoin above 91,000, almost to 92,000. So we've had a dramatic reversal of sorts with Bitcoin and Ethereum. Bitcoin currently up about 6.5%. Ether up about almost 8%. You can see the top 10 coins tracked on the stock charts platform, all in the green. Again, we think about what the VIX tells you about stocks. If there was a VIX for crypto, it'd be pretty high and well above 16 or so, because the normal daily fluctuations on these markets are often expected to be much, much wider. So things that go down aggressively, like Bitcoin and Ethereum have, certainly can come up aggressively. That's what we're seeing here right now. As much as that 6+% move in Bitcoin seems super impressive, and again, it's encouraging. Keep in mind, though, the chart of Bitcoin is still not a great chart. You'll see that we didn't even erase what happened yesterday and in the last couple of days here. So still a lot more to prove, I would argue, before there's an all clear of sorts. But getting back above that big round number of 90,000, certainly a psychological level, I think could be important. Looking at the 11 S&P sectors, technology up 1%. That's your top performer, the XLK. Industrials, also a decent up day. The XLI was up 0.9%. Communication services, third, up about 1/3%. Everything else flat. to down. On the downside, energy was down 1.3%. Materials, which is the XLB, was down 0.9%. Utilities down 0.7%. That's third. So three sectors that were up were tech, communication services, two of the growthy sectors, and then industrial is one of the more traditional value-oriented sectors. Breadth wasn't great today. As we mentioned, only three of the S&P sectors up, and most stocks finished the day down. The breadth was worst in the mid-cap space, which had the worst performance of those major indexes. Is that true? That's pretty much what I remembered. Yeah, mid-cap's down about 1/3%. Not that bad of a day. You can see in the mid-cap index, two stocks down for every one that was up. A little more even on the New York Composite Index. Decliners a little bit outpacing advancers, 54% down, 43% up. So more stocks down than up. But those aren't horrible breadth numbers. Besides mid-cap, which is kind of weaker, these are more neutral kind of general numbers here. Looking at the Magnificent Seven and Friends, this is why with the weaker breadth, with most stocks down today, the fact that a critical mass of huge names being up a bit is enough to push the S&P and the NASDAQ slightly higher. So Apple, your top performer, pressing those new all-time highs here in December, up 1.1% to 286 plus. Meta up about 1%, which is encouraging because Meta's been arguably, along with Netflix, the two ugliest charts out of this bucket. So Meta up about 1%. NVIDIA up 0.9%. NVIDIA, the chart is still not great relative to charts like Alphabet and others, which are making new highs. On the downside, only two of these stocks were down, most notably Broadcom. A lot of the semiconductors were up. Broadcom is actually down 1.2%. Broadcom's up pretty good recently, but kind of stalling out. You know, it's funny, just looking at the little chart here of the S&P 500, this is what yesterday and today have been. Look at how the open and close are almost even. These are called doji candles. They're not perfect because ideally a doji candle, the open and close are identical, but these are pretty close. And what that means, think about what that represents, right? We're coming off of a week where every day these big open candles, which tell you we're closing above the open, we're seeing accumulation through the course of the day, albeit on lighter volume last week. Today, Monday and Tuesday, open and close even. So as opposed to last week where we're open, we're trading around, but by the close we've appreciated. Here we're not really gaining any ground. So some things are working, but on average, it's not really, turning into significant upside for the major indexes just yet. All right, let's continue on here looking at the market carpet, the heat map. As a reminder, questions are welcome and certainly encouraged. We've got some great questions already queued up for our next mailbag episode that is slated for Friday of this week. We'd love to have your questions as part of that. Please use the comments section on our YouTube channel and share questions as they come into your brain. All right, the heat map, not a great day, right? You can see the sort of average color seems neutral to me. Things that stand out to me, obviously in the upper left, technology, toward the upper right, industrials. These are certainly the two strongest sectors, and communication services was the third one that was slightly higher. The problem there is Alphabet and Netflix, two of the biggest names, didn't have much of an up day, and that's also weighed down by stocks like AT&T and Disney having down days. But communication services, okay. In the upper left, technology, look at all the semiconductors, KLAC, Applied Materials, what else? ON, M-Chip, M-Power. These are all stocks that traded higher today. So that's encouraging, but not everything, right? It's interesting that Broadcom down, Micron down, AMD down. So this wasn't like all the semiconductors are up or all the semiconductors down, a little more mixed. But Intel, becoming a choppy, sloppy chart, but overall net positive. Intel, one of the better performers here in the S&P today, up 8.7%, making a new 52-week high today. So the largest semiconductors, the largest technology stocks, NVIDIA, Apple, Microsoft, all up, which is helping the major averages. A little further down in the S&P 500 names, you're going to see some of the brightest green. So some of the biggest moves came in the technology sector. That's what would need to happen for this market to go significantly higher. It's got to be driven by growth. If the growth stuff is lagging in value sectors like financials and healthcare do well, it's just not enough market cap there relative to the growth sectors to move the needle on the major indexes, right? The S&P and the NASDAQ obviously tied much more to growthy sectors. Keep an eye here, however, on the industrial sector. Boeing up 10% today. Still a little bit more to prove. We're still in a primary downtrend of lower highs and lower lows, but encouraging. GE Vernova, one of the spinoffs from GE, I think that was earlier this year, bouncing off of 550, kind of having a nice November, continue to push higher here into December. Caterpillar, very close to making a new all-time high. It's kind of right up at that point. So if you've been ignoring the industrial sector, I don't blame you, but don't forget names like JB Hunt are breaking out. Names like UAL. This is fascinating. Something like airlines are having these encouraging breakouts. But not too long ago, right, a week ago, UAL is sort of in moving average limbo, right, where we're between the two moving averages. The moving averages are flat. So in that sort of technical setup, I would argue is sort of a sit on your hands moment. We've broken the 50-day, so it's telling you that short-term uptrend that was happening back here is no longer active, right? We're now kind of pulling back with sort of retracing some of the previous gains, but we haven't broken the 200-day, which is where a lot of investors would say, all right, that's a big, significant breakdown. We're kind of in the middle, and so you wait to see which way we break. And what's happened in the last week now, you're pushing to the upside. Now, what's encouraging today is we're actually pushing above $100 a share, big round number. RSI just pushing just above 60, could be the sign of the next move higher. I didn't have a chance to analyze this first. Actually, the first I'm noticing that this happened today. But when I see a move like this, I immediately want to put on Fibonacci retracements and just get a sense of where we are now on this pullback versus where we're at. And so this is what I was kind of thinking, right? This is a great reminder to not forget Fibonacci retracements and kind of your arsenal of technical tools to put moves into context. After we have this big run higher, and we start to roll over, we start to break the 21-day EMA, we start to break the 50-day. Now we have a clear low in April. We have a clear high in September. 38.2% of the way is right at 88.40. That's almost exactly where the 200-day moving average has been for the last 3 months. So you've got what's called a confluence of support, a number of different techniques, all kind of agreeing on a particular level. And whether or not you believe in the magic of Fibonacci numbers and retracement levels, I find having a clear line in the sand, a level where you think about a potential opportunity, you can clearly define your risk because you have an idea of how much downside you're expecting before you would consider this more of a larger downtrend. I think, looking to re-enter it when we get down around 88 or so, which would be tagging the 38.2% level and the 200-day moving average for now, doing pretty well, which means as long as we remain above there, it's a nice sort of setup. And then watch out if otherwise. I'm going to add this to the show, just so I don't forget we looked at it. That was a pretty good example. I think that's it for the heat map. And the other thing I would say is with the energy sector, right? We've noted how energy has had a pretty good bounce, and charts like Diamondback, DVN. I think we highlighted one of those on yesterday's show. Just starting to break out. I think I had it in my Stock Charts TV show. We talked about APA and some of those other names. A lot of those pulling back here today. Still a choppy area. Crude oil prices still not looking particularly strong just yet, but certainly an area to watch. Consumer staples fairly weak as well. The other observation is if you pick a random sector like financials, you'll find a couple things that are up a decent amount, a couple things that were down a decent amount. Besides kind of technology, everything else was sort of mixed, right? Kind of a mixed results kind of day. And again, it just sort of fits into that narrative we've been talking about, sort of a quieter period, still waiting to see what the next big move is going to be, I would argue. All right, we're going to continue on looking at some charts here in a moment. Just a brief shout out to our friends at Seeking Alpha, longtime partner of the channel. They're doing their Black Friday sale this week. You can go to marketmisbehavior.com/alpha picks. That is one of their products where you can where they actually use their quantitative methodology. They hand select some names to dig into a little bit deeper. They share them with you with a lot more context and color. Great way, I think, of illustrating the value of a quantitative, systematic scanning and an analytical approach combined with more subjective deep diving into particular names and stories. You can find more information and get 20% off their Alpha Picks platform at marketmisbehavior.com/alpha picks. Let us continue on looking at some charts, shall we? Last week, lighter volume, but the S&P did break above this trendline resistance, as we talked about with our premium members over the weekend. It's a great setup. However, it was a holiday week. It was lighter volume. Let's wait until the first week of December and see what actually happens. Is there additional buying power coming in the market? For now, I have to say the answer is not yet. It doesn't say never. It doesn't say tomorrow we can't have a continuation of the uptrend with stronger price action on stronger momentum. It's just so far this week, we're kind of stalling out here. So it kind of plays into our expectations of limited upside and the risk of downside. Again, a lot to not like, I guess, is the way I would think about it. Still isn't a bad chart here. A number of people have asked me about a head and shoulders top, and a shout out to Dale Pinkert and Blake Morrow and the folks at Forex Analytics. Been working with them for a number of years. Have enjoyed contributing some content to them, and I went on their Face interview earlier today. Talked with Dale Pinkert for about 30 minutes. Talking about different charts, how it relates to some of the stuff they're doing, which is a little more short-term oriented, looking at a lot of currencies and other markets as well. And we were looking at some of these charts that kind of look like head and shoulders tops. And you're not wrong. I mean, it is a potential head and shoulders top. It's not the perfect one. I wouldn't include this as the visual aid in a book where I'm writing a chapter about head and shoulders topping patterns, but it does kind of have that toppy feel. What you have to remember, though, is the chart looks kind of like a head and shoulders top versus this is a confirmed head and shoulders top that suggests a major topping pattern for this index. Those are two very different things, right? And it's easy to say, oh, it looks kind of like a head and shoulders top. That's it. I need to be short the market or whatever you want to say. It's too early. According to the best practices of technical analysis, any pattern like that has a trigger. That trigger is usually a level, an indication that the pattern is valid and that it confirms the topping pattern. In this case, you really need to break below 65.50 and clear this neckline from the October and November and honestly the September lows as well. So for now, it could end up being a head and shoulders topping pattern of some sort. We've certainly made a couple lower highs now, but until we break below that 65.50, it's not a bad chart, and it's not really a confirmed topping pattern just yet. So you got to be patient with the chart with a pattern like that. If and when we break 65.50, I'll be the first to let you know that's a valid pattern. For now, it's a potential topping pattern, but not confirmed yet. Breadth, as we talked about earlier, not great today, right? Two stocks down for everyone up in the mid-cap index. Not as bad, but still not great in the other areas of the market that we're looking at. Here's the percent of stocks above their 200-day moving average in blue. In the bottom panel, percent of stocks above their 50-day moving average. Both of those surged higher last week. And again, not unexpected. And so percent of stocks above their 200-day got just above 60%. It started to roll over this week a bit. Percent of stocks above their 50-day finished last week around 60%. It's already down to around 51%. So even though the S&P and the NASDAQ kind of holding steady so far this week, but a number of names are just starting to break down below their 50-day. This could be one of those key charts to watch. A lot of times at a top, you'll have kind of a stealth top, meaning the indexes are still holding in, but a lot of stocks underneath, right, that aren't really reflected on the chart of the S&P, but some stocks are already starting to break down a little bit. These breadth indicators are where you can often pick up on that signal. So we'll keep watching that. A break below 50% would not be a good sign, even if the S&P and the NASDAQ are all holding steady. Put call ratios, I don't look at a ton. I probably should look at more. And anytime I talk to someone who's a big put call, person, I always think, oh, shoot, I should have that as a better part of my routine. I'll probably fix that at some point. But I did want to notice this is a 1 day lag. This is actually current through Monday, but last Friday, it's worth noting the put call ratio dropped way the heck down. I don't know exactly what happened there. This is the raw data in the background in gray. The daily put call data is super noisy. And you can see some of these huge spikes that you see from one day to the next. It's one of the challenges of using the put call ratio. It's a great kind of short-term signal, but as a longer-term indicator, it's tough because it's really based on short-term data. However, you'll find when the put call ratio is very low, that often coincides with peaks in the underlying index. In this case, looking at the S&P 500. And the reason is because it just shows you, it implies how options investors are positioned, and it's a good contrarian signal based on the movements in the S&P. So the last couple of times the raw data got down to where it was on Friday. Those have been some of these short-term peaks, not long-term tops, but the next couple of days have been sort of drifting lower. So interesting to me that put call ratio spiked very low. right as the S&P was rallying into Friday's close. We'll see if that continues through the course of the week. The 5-day moving average, which is what I have here in pink, is still pretty high, but just that raw data spiked down a little bit. Something we'll continue to monitor, but something that stood out at me as I was going through some sentiment charts earlier today. Boy, Bitcoin, I feel like, is another word for volatility, right? I mean, if you think stocks are volatile, you know nothing about volatility, because the cryptocurrency space is just the definition of huge swings. It's really driven primarily by speculative pressure. This is when people want to speculate one side or the other, which is why you get these big percentage swings. So the history of Bitcoin has huge drawdowns, much more frequent and much more severe than what you'll see on like the S&P 500 or the NASDAQ charts going back in the brief history of cryptocurrencies. So yesterday, huge down day. We got down to around 84,000, ended up finishing yesterday around 86,000. Today, pushing higher, currently around 92,000. That's not bad, right? We're sort of going higher, but we're still below where we were over the last week, right? If you think about the range in the last week, it's up to around 93,000 on the upper end, down to around 84,000. We're sort of toward the upper end of that range. So, something certainly to watch. Maybe this is a higher low around 84,000 and the bigger rotation at work. I would say getting back above 93,000 would be pretty helpful. That would be pretty meaningful. That was a key downside objective we've talked about. Now, after we kind of reached this peak here in July, we retested it in August and October. Once we really start to accelerate, we can use some of these Fibonacci levels as potential downside targets. 104 was an initial target. That eventually was broken in early November. 93,000 is the next one down. That's the 61.8% retracement. We didn't even pause there in mid-November, but we did bounce up to there about a week ago before rotating lower. Let's keep an eye and see if we can break back above 93,000. That would be pretty encouraging. Other thing I would look for would be a much bigger movement in momentum. There hasn't been enough upswing in the RSI to suggest real accumulation here. This feels more like a counter trend reversal. There's plenty of news around Bitcoin and other cryptocurrencies in terms of institutional participation. But from a technical perspective, I would still say a vulnerable chart here. Before we get to some individual charts, I just want to share a ratio that I look at pretty often. This is a ratio of two ETFs from Invesco, the high beta ETF, which is SPHB, and the low volatility ETF, ticker SPLV. Now, what are these managing? Beta is basically a measure of volatility, a measure of risk is how I would describe it. If a stock has a beta of 1, that basically means it moves generally with the same fluctuations as the S&P. If a stock has a beta above 1, like a beta of 2, that means if the S&P moves 1%, that's probably going to move like 2%, right? It's going to be more of a leveraged move on the S&P. If a beta is below 1, that means it's going to move lower. So things like biotechnology, emerging technology names tend to have a beta above 1, higher beta, more risky. Real estate, utilities, consumer staples, kind of more income-oriented names tend to have a lower volatility and a lower beta. So this is basically a ratio of the higher beta, those more offensive areas of the market, and lower volatility, more the defensive areas of the market. So I want to highlight, obviously, this ratio was going lower well before actually the market peak in February of this year. Excuse me, did trend lower into the April market low, rotated higher, and all through the rest of April, May, June, July, a little hiccup in August, September, October, this ratio has generally trended higher as the market's been more of a risk-on footing. Through much of November, the ratio is going down. This is part of that rotation, that leadership rotation we talked about on the show in the month of November, talking about a rotation away from growth leadership and into defensive sectors. Last week, again, is shortened holiday week, but this ratio is popping back higher as more of a risk-on week. The question now in December is, does this ratio go higher? And if you're bullish here, I think you really want to see this ratio go higher, because that's what could propel the S&P and the NASDAQ to strength through year end and into the beginning of next year. If this ratio would roll over and start to go down, that would indicate that last week was kind of a brief spike in risk, and then all of a sudden investors are going back to risk off positioning. So this ratio could be a really important one to watch. We'll certainly keep an eye on it for you and update you if there are any significant changes. All right, a couple charts in uptrends making new 3-month highs today. But on weaker momentum, Warner Brothers Discovery, WBD, is one of those media names in the communication services sector, gapped higher here in mid-October and then just completely moved on from that September peak around 20. I love the gap and the follow through. So we call that a gap and run, where it gaps higher and then you see additional buyers coming in. That's a pretty encouraging sign when you see a gap higher and then you see additional upswings. What that means is that investors are optimistic and they're taking on additional, accumulating shares is what the implication is. As the trend has gone higher, and don't get me wrong, the trend is great. We're making higher highs and higher lows. We're above upward sloping moving averages. They're in the proper order. That's all good. But note how the last couple highs in November and now early December have been marked by weaker momentum. We're right at that point where if we can continue higher and have the RSI push above 70 a little bit further, that would be a really encouraging sign, implying much further upside momentum. For now, the trend is good. I would love to see follow through. For now, potential RSI divergence. Same kind of thing here with General Motors, automobile stock, obviously in the consumer discretionary sector. Similar to what we saw with WBD, the gap in October, that was on their earnings report. Another gap and run. We gapped higher. We saw further accumulation, higher highs, higher lows. Here we tagged the 21-day EMA in mid-November before making a new 52-week high. But note how the highs in October, November, and now December have been marked by declining momentum. So there's one of two ways that a chart like GM can resolve, because it's unsustainable that the price goes higher on downtrending momentum. That can't last forever. So one of two things happens, right? Either the divergence holds. Eventually, this is a sign of exhaustion and we break down. A break below the 21-day EMA could validate that. Certainly a break below 67, which would clear that November swing low. That would be the sign that, yep, it's a top. There's the breakdown. The divergence was true. The other way we can resolve this pattern is the price continues higher and the momentum improves. So a subsequent new high on stronger momentum would invalidate that. And we actually saw that on the chart of the S&P and the NASDAQ earlier this year as we broke higher into the fall. So GM, kind of a crucial time from a trend perspective. The trend is good. The weaker momentum tells me watch for a potential bearish divergence. Two stocks to highlight in the consumer staples sector, and then we'll call it a show here. First, Dollar General, DG. I want to highlight here. I feel like it's Fibonacci day on the show. Three things I want to highlight on this chart. Number one, back at the January low around 65, down up to the April peak at 96. So Dollar General did the complete opposite of the S&P and the NASDAQ. That was selling off February into April. DG was actually rallying during that period, which is why the relative strength was so awesome right about then. However, we pulled back, and note how we got right to the 38.2% retracement. That actually lined up very well with the 21-day EMA. So similar to a previous chart, kind of a confluence of support, two different indicators lining up at the same time. Great example of using Fibonacci retracements for short-term swing trading purposes. But on a larger time frame, it's also working out pretty well here. That same January low to the June peak around 114, we retested that peak a number of times in July and August, failed to really gain much beyond there. We pulled back. Look at where we eventually bottomed out, the 38.2% retracement of this larger move. So Fibonacci retracements can be used on multiple scales, on multiple time frames, good for short-term swing trading, but also for longer-term opportunities. In this case, we bounced off of that support just above $95 a share in early October, that is. We then retested that level here in late October, early November. That actually lined up with the 200-day moving average. Again, confluence of support, multiple indicators suggesting a good opportunity. For now, we spent the last month rallying off of that level, now making a new 2-3 month high, breaking above 108 this week, pushing just above 110 going into the close today. So I like that breakout above short-term resistance after a successful test of support. Like how the momentum is improving on that breakout as well. That's a nice bullish sign. Two more charts here. Walmart, another one making a new all-time high today. This is obviously one of the big box retailers. We're making new highs. We're breaking above 110 for the first time on an adjusted basis, and the RSI is pushing toward overbought conditions. Could mean at some point we get a short-term pullback, but I would think of a chart like this as innocent until proven guilty. Final chart, BKNG. This is one that's not quite ready. If you think about what we talk about with the 200-day moving average, right? Look at what happened with booking in November. We had this pattern, which is called a Dark cloud cover pattern. We have a big up day, a big down day, higher open. The close is at least 50% of the way down through that first day. That's called a dark cloud cover candle. Happened right at the 200-day moving average, happened right at a Fibonacci level. All great reversal signs. We rotated lower. We actually got below the 61.8% retracement of that April to July rally. We then eventually got back above there, which is an encouraging sign. Sometimes that's where I'd take an initial position on a chart. I did not with this particular stock, but that's kind of one of those great signals. When we get below the 61.8, wait for that break back above. That can often be the sign of a good recovery. Now we're actually threatening to overtake that previous resistance. So the last time we got up to this level was mid-November. We stalled out with this bearish candle pattern at the 200-day moving average at this Fibonacci resistance. If we can get above here, if we can power above 5,200 and clear all three of those resistance levels, that could be a great sign of recovery and a fantastic name having an initial bounce off of the lows from last month. Folks, always a pleasure to share some charts with you. I hope that this helps you make sense of what you're seeing today. Hope it gives you some ideas about charts to watch, but also it helps educate you on how to use technical analysis tools and techniques. I'm a big fan of using charts to improve your market awareness. I hope that this helps you do so. If what we're talking about here makes you want to learn more, if you want to have a little bit more hand-holding, virtual courses, a supportive community where you can ask questions any time of the day or night, as well as some members-only reports like our weekly flight plan and our monthly chart review and much more, go to marketmisbehavior.com/premium. We are running our Black Friday sale this week. Use the code SPXDAVE, SPXDAVE. When you check out, I'll knock 40% off your first 12 months on any plan. That is my gift through the end of this week for Black Friday, and that'll be it. So find out more information on our premium memberships at marketmisbehavior.com/premium. Again, don't forget to use the code SPXDAVE for 40% off. Valid only this week. I hope to see you as a premium member very soon. That'll do it for today. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Have a good night, folks.